We thank you, Allon, for this. Dancing with Sharks and Dragons is around the information of Shark Tank came out and then Dragon's Den, where people are looking to get money for their businesses. And people then came, when they're looking for businesses, saw the TV show and thought that's how you do it in reality. And it has some elements, but as Allon will tell you, it's not exactly like that. And a VC stands for venture capitalist. Who is Allon? For those of you who don't know who Allon Raiz is, he's the author of 2 best-selling entrepreneurial books, Lose the Business Plan and What to Do When You Want to Give Up. And those are 2 so important things in a business, is one, having a business plan, but knowing that the business plan is more than just on paper, it's in your head. And every single entrepreneur at some stage wanted to give up. And what do you do to go above that? But Allon has hosted radio shows. His entire focus is entrepreneurship. He's got a reality show around pitching and polishing the information that you give when you're presenting. He's now gone into a cartoon strip that he creates. He's running a TV show on Business Day TV on entrepreneurship. And he also writes a column for the newspaper. So very, very busy, but all of it, the theme that runs through it is around entrepreneurship. He founded Raiz Corp, and it supports over 500 different businesses. And maybe, Allon, maybe this is a little even out of date. I think his target initially when he started this was, correct me if I'm wrong, but he wanted to go for something like 20 companies, and now it's 500 companies. He was awarded an award from the World Economic Forum as a global leader. He's been a guest speaker, or is a continuous guest speaker at Oxford University. He even received an invite from the White House to speak on global entrepreneurship in a summit that was in Kenya. So besides all of this, as I mentioned, he runs a show, and I think it's going for over 10 years now, Pitch and Polish, where people bring their businesses, real businesses, and they pitch it, and they win awards. But Allon is running that and on the panel of making sure that people do it correctly. So Allon, hopefully you're going to share with us what are the green lights and the red lights in terms of what should we be doing if we're looking to raise money for a business, and definitely what we should not be doing. So with that, Allon, thank you, and over to you.
Thanks, Dave, and thanks to Ort for inviting me, and thanks to everyone for spending the evening with me. I'm going to spend the next hour with you. I'm going to try and get through the presentation quite quickly, and then I'm far better in Q&A. Dave, just some corrections. Yeah, so that's 500 businesses we look after right now. And Pitch and Polish, which last year went digital, we had 2.5 million views of Engine Pitch and Polish last year, which was very nice because I promised the sponsors 20,000. So they think I'm quite good on that. But it was much a surprise to me as it was to anyone else. So let me just try and share my screen here. Thanks, Dave, for that intro, and it's exactly that inspired this talk. I do quite a bit of speaking around the world, and what I noticed after Shark Tank and Dragon's Den started coming out is that people started pitching very differently after that. And part of Raiz Corp is VC. We do have a division called Partner Elite where people come to me to present their businesses for us to invest in them. And I saw the same thing in my own boardroom and decided that I had to change this, and that what was going on TV wasn't really necessarily the right way to pitch to a venture capitalist or an investor. So this talk here is really based on some of the things that I've picked up over the years. I've had probably more than 500 pitches directly to me in a boardroom. And if I include things like Pitch and Polish and various other things that I'm involved in, over 1,000 pitches. So I've tried to take all that information and try and discern which are the best tips for you to give you the highest probability of raising finance. So the thing that happens in Dragon's Den or Shark Tank is that people walk in, they go, "Hi, my name's Allon Raiz. I run a company called Raiz Corp. It's worth a gazillion dollars, and you can buy 10% at a tenth of a gazillion dollars." And then they start their pitch. And they talk about the deal up front. They bring the deal up front. So they're basically saying, I've got 10% or 20% or 50%, and the business is worth X, and this is what I've got to offer. And that's fantastic for TV, but it's not necessarily good for a pitch. The right way to do it is to not speak about the deal at all. Anyone who's in the audience right now, in the room right now, who's in sales knows that you don't start talking about price up front. You speak about the features, the benefits, the pain, how you're going to solve that pain. And you talk more around, in the case of pitching a business, you talk more about what the opportunity is, how you're going to solve that opportunity, and various other things to reinforce you as a good investment. You do not start the whole discussion with, "Hi, my name is Allon Raiz. I run a company called Raiz Corp. It's worth a gazillion dollars. And for you today, I'll offer you 10% for $100 million. You don't do that. And yet I see it time and time again. The second point I want to make here is about taking notes when investors speak. So I've noticed over the years that entrepreneurs who take notes, write down the questions, write down things that they've picked up, are the ones that have got far more probability of raising funding. And this is based on two things. The first is the psychology of what's going on. If an investor is busy speaking to you and you're taking notes, the signal that you're providing them is that what they are saying is important and that you are open to learning. And so just simply by writing down notes based on what they're saying, the subconscious signaling is going to put you in a far better light in front of that investor. But if you are more authentic, if it's not just about the signaling, if you're far more authentic, then what's really happening as well is that all investors leak information. They leak information that is going to serve you, whether it's in this pitch or in other pitches. So they will leak, for example, by asking you a question that you might not know the answer to, what's important to them. If it's important to them, it's probably important to the next investor. So anyone who's pitched to venture capitalists or investors will know that it's very unlikely you go to the first individual and boom, you get your money, you get your investment. Very often you'll go to 2, 3, 4, 5, 6, 7, and even more than that over time. If you are continuously writing down notes and reading those notes and trying to understand what is common between all the investors as they've leaked information to you, either through questions or through just speaking, you will start to be able to hone your pitch to have a high probability of selling. So go with a pen and paper, write down notes, inform them subconsciously. You're open to learning, you're opening to listening. The third tip I have for you is around selling your experience and that of your team. Any investor knows that a business plan, and Dave showed you one of the books that I have written called Lose the Business Plan. And I'm not saying don't do the business plan, I said lose the business plan, because from my experience, all business plans look exactly the same. I have always got a J curve in them. I need lots of money. I need even more money. And then year 3, I'm going to make lots and lots of money. You have your company name in Calibri font 14 at the top in the center. And that's the story you tell. Okay. But investors are a little bit wise to the fact that that's not actually what really happens. And their biggest risk is execution risk, that you say you're going to do this, but can you actually do this? can you execute on this plan? So by starting early on in your presentation, in your pitch, by talking about your experience and more importantly, the experience of your team, you're actually conveying to the investor that there is a high probability that you have the ability to execute on this plan, especially if that experience highly correlates with what that you are wanting to start up in your business. And I've had other situations where people have got into new businesses and they don't have the deep technical understanding themselves. And that's where the team is very important, where the team might have that experience, but you don't have that experience. The investor would look at the combination of the two and say, perhaps you're a good leader, perhaps you're a great entrepreneur, you don't have the technical experience, but it's there up in your senior management, in your senior team, that experience is very apparent and that is expressed. And this seems so obvious, and yet probably 60 to 70% of all the pitches that I've come across do not have this part of the pitch in. They're selling the idea, they're selling the opportunity, but they forget to sell their experience and the experience of their teams. The fourth tip is to talk about risks. And risks, to me, is something that any investor worth their salt knows that there are risks inherent in every single business. If there weren't risks, they wouldn't actually have a job as a venture capitalist, because the banks would step in, because banks don't like to take risks. And so if you've come to them, that means you've gone a route, and you probably now need money that is prepared to take risk. So if you know that a venture capitalist is there because they are prepared to take risk, then their lens is all about their tolerance for risk and how much risk they can tolerate given the return and given a whole bunch of other factors. If you don't bring up the risk, if you don't bring, not the risk, the risks, if you do not bring them up, the investor will bring them up. And you're already on the back foot, because they will invariably ask you, what about this? What about this risk? What about that risk? And the moment that happens, you are on the back foot. So my strong suggestion is that quite early on in the pitch, you start expressing the biggest risks, and you speak about, and you'll table them as these are the 4 or 5 largest risks. I'm getting a bit of feedback there. These are the 4 or 5 largest risks that I have identified, and this is how I see them and what I've put in place to mitigate against them. If you say there are no risks, this is a sure thing, the one thing that's for sure is you are out of that door. Do never say this is a sure thing and risk-free. It's actually quite insulting to a venture capitalist who understands that there are many, many risks involved in investing in a business. So do tell them about the risks. The second thing relating to this is about, in your mind, knowing if you're going to, because of time constraints, you're going to bring across the 3-4 top risks that you have identified. Identify probably 4 or 5 other risks that are probable. And when you were writing down all your notes, your venture capitalist would have asked you a whole bunch of questions, which would invariably have been a question around risk. So write those down. If they're not in your top 4, then prepare answers around them. And let me just underline this: prepare authentic answers around these risks. And so when in the Q&A that happens afterwards, they ask you about, what about this risk? What about this risk? Then you are prepared with those answers. But do not lie. If you do not answer and have the answers, or there is risk in there, then express the fact that there is risk. And perhaps this is a risk you cannot remove from the equation. You'll get far more credit for saying that than trying to BS about the fact that there's no risk. Number 5 is also to tell them about competition, because competition, once again, is another form of risk in the system. So I just want to just frame this competition thing as well. I think what's important is not that there is competition, but what is the competition going to do when you arrive in the market or start to expand in the market? You know, I've been doing this entrepreneurship thing for more than 20 years, and I've never seen a situation where the competitors lie down and say, tickle my tummy. They will come back and try and squash you and try and remove you from the market. Now, the investor knows this. So you are preparing your whole thing about, competitor A, their unique selling proposition is X, Y, and Z, and our unique selling proposition is ABC, so we are different. So that's how we are different to our competitors. And we're going to beat our competitors because the market really wants A, B, and C and not X, Y, and Z. What the venture capitalist, what the investor is really wanting to understand is when the competition comes at you by dropping prices, by stealing your staff, by forcing suppliers into exclusivity agreements, by a whole bunch of other dirty tricks, what are you going to do? Have you anticipated what they're going to do? And what are you going to do when that happens? Once again, if you're not prepared for that, you are going to find your way to the door quite quickly. And if anyone comes to pitch to me, I just know that there is always this very strong signal from myself that, you know, I'll offer you tea or coffee. And the moment I believe that there is no depth or no understanding, I will look at your tea and coffee and hope that it is nearly finished, because the pitch in my mind ends at that point. So I'm just looking to see how quickly you finish your tea or coffee, so I can give you all the body signals that it's time to go. So this is one of those moments where you do not misunderstand what the investor is looking around competition. Then you get that fancy business plan that I said, and on, you know, there's always an beautiful income statement done on Excel, and you've on your Excel spreadsheet you've gone, you know, we're going to do 100, then 150, then 200, and then you're going, well, damn it, let's just drag the whole thing. And so you're going to drag the revenue line, and you're going to show the revenue line, and then you're going to put on your expenses. You're going to put your expenses down there, and you know that they're going to want conservative expenses. They're going to put some fat into that. And because you went on this clever Excel course, you know, on month 13, it's going to all bump up by times the inflation rate, all that, and it's beautiful, and it bumps, and it's all fantastic. And you're going to present this beautiful plan, and once again, it's going to show that J curve. What I do when I look through the budget, the income statement budget, is I go straight through to look at your salary as the salaries. If those salaries are market-related salaries, I will start looking at your cup of tea or coffee. It is over. Because what you are communicating with me is that you must take all the risk, and I mustn't take you as in the investor must take all the risk, and I, as the entrepreneur, will take no risk. I will get market-related salaries no matter what, and you can pay. And if it doesn't work, well, I'm okay, Jack. I'll just go and find another job. So that market-related salaries thing is big. Now, not all investors look at this, but certainly ones that have been in the market for a while do look at that. So it's not that there should be no salary. It is the fact that that salary needs to be not market-related, substantially not, and not by 5% or 10%, but 30, 40, 50%. I've seen it right down to 80%. But as the J curve, you know, starts to go up, as the revenues go up, as more importantly, the profitability goes up, then you start to bump your salary up in accordance with success. And so that you normalize your salary as the company becomes profitable. Once again, you're communicating to an investor that I am serious. I believe in what I'm saying. I'm putting skin in the game through salary sacrifice. And therefore, you know that I am taking this as seriously as you should. So that's the communication there. Number 7 is about low net margins, low net investor appetite. Now, there's certain industries like retail where there are inherently low net margins. So that always has to come with high volumes. So you've got two things to prove in a startup with low net margins. One, that you can maintain your costs and your cost of sales quite diligently upfront to ensure that you can make even a net margin. And then more importantly, that you can create the volumes over time that will make those low net margins worthwhile. And as a startup, you're starting up, so generally the volumes are not high and you don't have economies of scale. And so you've got to tell a great story about how you're going to control your profitability, your net profitability. And then coming back to the competitor story, coming back to the whole the fact that your competitors, especially in low margin industries, know this and are going to just cut prices and basically bleed you out until you disappear like the 100 others that try to enter the market. So investors tend to not like these low net margin businesses and prefer high margin businesses. So I'm saying that if you are starting up a business and you have a choice between a low net margin business and a high net margin business, rather choose the high net margin business. It's far more forgiving if you make, not if, when you make all the mistakes you will on the journey upward. So number 8, the operational experience is crucial. I want to tell a quick story here. And the story is about, I was on the board of the investment committee for one of the banks. It was about 8 years ago. And there was a story around, I was trying to convince this investment committee that they should not do a deal without meeting the entrepreneur. They were used to having their team go and do the whole investigation, put together the pack, do all the due diligence and come present the business and what they call the investment hypothesis. And then they gave you a pack and then you went with questions, and there was a team, literally a small team of 3 to 4 people from the bank pitching an opportunity, okay, not the entrepreneur. And I convinced them to change that methodology. And so we were looking, it was for deals of 75 million rand or more that this committee was looking at. And so there were 2 deals we were looking at on that day. One, I remember, made those concrete pipes that sewage and water runs through. And the other was that makes decking, but not wooden, out of plastic that looks like wood. So these 2 came in, and the general consensus before the entrepreneurs came in was that we should invest in the concrete pipe business and not invest in the wooden or plastic wood-like decking business. And then the entrepreneurs came in, and I asked one question to both entrepreneurs. The one with the concrete pipe business, I said, how do you make money? How is money made in your business? And the entrepreneur looked at the individual next to them, who was the engineer, and said, you know, David will answer. And I said, no, you the CEO, you the entrepreneur, you're looking for the 100 million rand. You tell me how money is made. And they couldn't answer the question. Guess whether we invested in that business or not. The other one, which was the wood lookalike decking, which would produce all this decking material to sell, was also looking for around 100 million rand for their plant. And I asked exactly the same question. And the answer was, no, we get the raw material from Sasol, we do and this is how it is. Our margins are made here. And he went right through the whole process and explained where money is lost, where money is made in that process. And he was one of the businesses that was not going to get money, and it flipped 180 degrees the other way. Your operational experience is crucial, but more importantly, here, the important part here is where is money made in operations and where is money lost in operations. The next one is around your ideal investor. So investors don't come in one, and entrepreneurs are looking for funding. Just see one thing, that there's like a whole bunch of investors out there, and I just need to approach them. And like as if they come in one flavor, one type. It's not true. The investors come in all different shapes and sizes, focused on different parts of the economy. Some like startup, some like post-startup, some are focused on scale, management buyouts, some focus on tech, some focus on agri, some focus on manufacturing, etc., etc. Some even will say, I specialize in investing in family-run businesses where there's no clear idea of where there's no inheritance or continuity in place. So you've got different types of investors. What's very important is that you research what your investor is likely to find appealing before you go to them. And this is not about just wasting your time and their time, which is the obvious answer. But the real answer is that when you are there and you finally find an investor who might be the right investor, and they say, well, who have you been to? And you go, I've been to this one and that one, and I've been to Allon Raiz, and I've been to this one, and you name all the people you've been to. They're going to think, geez, what did they not see that? Like, why did they all reject you? Right? That might not necessarily be true, that they might not have seen the angle in it. But the more people in that line, and the more like really, really great investors that you've gone to, the less likely you are going to find money. So you've got to actually make sure that you're very, very strategic and pointed as to who you're going to go first, to pitch to second, third, fourth, and so on. Okay. And by the way, if you lie, it will come out, because investors speak to one another. Language is something that I think is incredibly important for me in the pitch, and to me is a big determinant of whether I feel comfortable to invest or not. If somebody is being asked a question, and somebody pitching is asked a question, and the answer, well, perhaps maybe it could be like, and they're a little shaky in terms of their language, it's not definitive language, then I become very nervous. It means that they don't know, they're communicating, I don't really know. But here's a corollary to that, is that if there's arrogance, that there is, I know for sure, it's 743 for sure. If there's too much definitive, if there isn't a bit of a soft edge, it's also bad. So there has to be a level of confidence and certainty in your language, but delivered in a humble way. Humbled in, my research shows me that there are 3,280 potential buyers for this in South Africa. Okay. There could be more, there could be less, but that's what my research shows. The fact that I was quite definitive in a number, I've done my research, but I'm still communicating that I could be wrong. That's the sort of the middle ground in terms of delivering certain language. This here is also when I start looking at your team, and this is so common for me, is when entrepreneurs go, the market size, and then there's MBA talk of the addressable market size is, and you'll use fancy terms like that, is a gazillion rand. And if we just get 5% of it, okay, then it equals this amount. And therefore, we are a great opportunity for you to invest in. Now, this is a matter of, I know that some investors don't mind this. I do. I mind this. Because for me, 5% of a gazillion rand industry is a big, big number. You're a startup. You're not going to achieve that number anytime soon. So if you are trying to communicate that, communicate it in units of sales. Either I'm going to get X amount of customers, I'm going to sell X amount of doofy jabs, whatever I'm selling, and you communicate it in numbers. So you'll say that I'm going to start off, I'm just making this up now as an example, 100, then we'll go to 200, then 500, then 1,000. Now the investor's going, well, do you have the capability to actually produce 1,000? Does your business case support 1,000? Is there a correlation between what you're saying in terms of growth and the underlying business that is required in order to produce that amount of units? Very often when you do that kind of stuff, that kind of calculation, it doesn't correlate. But it especially doesn't correlate when you go 5%, if we just get 5%, because 5% of a huge market might be 500 million rand. 500 million rand, the investor's already going, you're saying you're going to have to produce 1 million units of these things in the next year. And buddy, your business case does not tell that story. So you get blown out of the water by making these big assertions up front. Rather be more conservative and break it down into units. And now, I said I'm going to try and rush this so we got questions, is the last example that I'd like to put forward, a tip, is around the concept of simple models. Investors, the simpler the model, the more investors prefer the model. So I'm going to tell you quickly the story about the pool table industry. And I'm going to tell you there's a story about David Zidel, who, you know, he is a great entrepreneur. And when he went, when he was a young man, he went traveling, and I see he's put his camera on now, right? He went, I'm telling you a story, Dave. It might not be the true story, but it's a story. I just need a character. So Dave goes off to the UK as a young man, travels around Europe, and he sees pool tables are very, very, very big in the UK. So he comes and he finds a supply, comes back to South Africa, and he convinces his uncle to lend him some money to go and buy the first pool table. And he works out that if you put those 1 rand coins or 2 rand coins into that, you're going to get X amount of games a day, and he's going to make lots and lots of money. But where's he going to put the table? His cousin's brother's uncle's son owns a pub, and you know, just down the road. So he goes to him and says, "Listen, I'll put a pool table in your pub. It's going to keep the people there for longer. Here's my research in the UK. It says that people who drink in pubs with pool tables tend to drink 1.38% times more, 1.38 times more than people without pool tables. It's a great thing for you. And we will share 50-50. You don't even have to put the money down for the table. I'll put it in your pub." And the guy says, "Fantastic," and it's great. And Dave goes there every Friday. He empties out the box, takes out all the 2 rand coins, splits it in half. The pub owner gets half, and Dave gets half. And this is great. And he's very, very excited. So he says, "Well, if I can do this once, I can do this twice." So he buys a second one, and a third one, and a fourth one. And Dave is very excited. He's getting fancy clothes. It's like he's buying those new Nike shoes. It's all going fantastic. It's really, really going well. And then there's a point where, like, he just can't get to all these pool tables. You know, so he decides to employ somebody that he knows in order to go and now also go collect the money. And one day, as the business grows, that employee gets called in by one of the pub owners and says, "Listen, Dave's making a lot of money. You know, we're drawing here, you know, like 5,000 rand a week out of this thing. I'll tell you what, let's tell Dave we got 4,000. You keep 500 bucks. Okay. Give Dave the 2,000, and I'll take the 2,500, right? So I can get a bit more." Okay. So that game starts. And so Dave says, sure, 4,000. Yeah, I think so. It's getting overtraded. The dude says, very overtraded. Lots of guys now with pool tables. It's really getting bad. And so Dave eventually picks up on this and goes, no, something suspicious here. And he works out what's going on. So Dave then changes the model, and he says, goes to the pub owner and he says, listen, I'm going to give you, I don't need this dude collecting money. Here are the keys. You just pay me 2,000 Rand a month. If you make 2,500 or 3,000, good luck to you. But if you make 1,000, if there's 1,500, that I should be getting, well, bad luck to you. So I'm going to collect 2,000 Rand a month, and you can collect whatever you want. And in Dave's business case now, as going to an investor, the investor has certainty, not that it relies on some person and how many coins and what's happening in that pub, and if there's a big function or it goes up, and if there's nothing, it goes down. He's not worried about that. He knows that every single month there's an annuity income coming from that pool table of 2,000 Rand. That model is far more like, it's the same business case per se, but modeled differently. And the investor is more likely to invest in a model where David has said, I'm going to have 100 or 1,000 pool tables getting 2,000 Rand a month each, versus one where he's telling the investor, we're going to take 50% of the takings. And that, ladies and gentlemen, is my presentation. Yeah, and that's really it. And there's my name, and there's my Twitter account, and there's me stop sharing.
Wow. You've given us like 20 years experience in like 30 minutes. So we're gonna open it up for any questions, but while we're waiting for the questions to come through, I've got a quick question for you. So the talk, and it's based on what we asked you to talk around, was when you're in front of a VC, what do you say and what do you focus on? The question I want to ask you is, if I'm running a business, how do I make my business a business that eventually I can go to a VC with? So what do I do to create a business that will become investable rather than just a David's pool business?
Right, so there's a couple of answers to that question. The one is that the business must not rely on David. If the business relies on David, it's not an investable business. And too many businesses rely very, very much on the entrepreneur, the founder. Now, if in the beginning of all businesses, Race Corp included, it relied on me. Today, I don't run Race Corp at all. My exco runs Race Corp, not myself. I cannot be there for a couple of months, maybe 6 months, 7 months even, and the business will run without me. Now, I'm not at the stage, maybe I'm not as evolved as I should be at this stage, because I love what I do and I get involved in it. So if you are intending to sell, that is, to sell or getting funding, you have to prove the fact that you're not that important to the business. The second thing is that there is continuity. That the continuity in terms of the business is in the middle management, that your senior and middle management can run that business. So you're not important, but you have to prove the sort of core of the business so that it's investable without you. So that's what, and processes, systems, all those kinds of things.
Ellis, I see you've written a question up. Do you want to unmute and ask Allon directly the question?
Sorry, Dave. Yeah. Hi, Allon. There must be an obvious difference between a new startup and an existing business wanting to upscale in terms of their approach to a potential investor. What is the primary approach difference one would use for those two cases?
I think the startup business is very much about getting to a level of scale that the economics work in the business. So it's very much about proving the fact that I can get to this level of scale where the economics work. And I can get there knowing that the competitors are going to come at me, that I've made mistakes in my assumptions. And so I have the ability to navigate that. And generally speaking, if there is a new industry, that there is normally a land grab, and that that there is an ability to grab as much of that market share as possible, as quickly as possible, and with an eventual profitability in mind. The likes of the Amazon and Facebook and all those great stories have got a huge amount of capital to fund the valley of death. Especially Amazon is a Bezos story is a phenomenal story, as is Elon Musk's story around Tesla. And those businesses just invested in market share. In businesses that are wanting to scale, that are at a certain size, it's can they scale? It's more around now, very often in businesses that are established and want to move into to grow, generally are going to either have to create new product, new markets, okay, and new geographies. So new products, okay, there's another risk in that. New markets, in other words, in the same geography in South Africa, let's say, but we're going for a different market, or we're going for new geographies, like I'm going to now open up in different territories. You're seeing this now in the Sunday papers with the big pressure on Discovery, for example, to keep growth going. They're going now to look at the Asia as a potential market for growth. That is about new geographies for the same model that they put pressure on there. Now, what investors know is that if you're going to new products, new markets, or new geographies, there's a whole set of other scary things that happen in when you do that. And so they were going to be wanting to get a lot of comfort that you can do that without the inherent risks taking you out. So that's where, and that when you scale, this is on both sides, that you scale, the concept of economies of scale is not a truism. Bigger businesses do not necessarily get economies of scale. In fact, a lot of research shows that businesses that double or triple in size, there is a negative economies of scale, because those businesses now require management levels that haven't been costed into that business, and the complexity that comes from that scale has not been costed properly. So yes, those would be the two.
I do see in the scale issue is when you start professionalizing elements within the business, costs escalate quite heavily. The other thing is, when you are assessing the potential market, should one go to market research companies to qualify your projections?
But I think it depends how much money you're trying to raise and where you are in the market. So if you're an established business that can afford that, the answer is yes, if it's verifiable and you can do that. If you can't, and most of the businesses, and I don't operate at that level, so I don't have that amount of experience. The market that I deal with generally is based on their experience and research from Gartner and their own desktop research, and they'll bring their own research in, or documents where other people have done research and they've brought that research in. They don't actually pay for their research themselves. But if I were a big business trying to get funding to go into a different market, different geography with a different product set, then I would do that.
From my mentoring experience with regard to the upscaling, I've always sort of said that there are three elements in a business. Your resource, being your staff and your skill. The product you actually are marketing, whether it's a service or a product. The third thing is the market you're addressing. And I believe with any upscaling, at least one of those three must be common.
Yes. So the way that I would see that is slightly differently, and maybe it's just different language. To me, it's about the fact that growth comes from core competence. And core competence is something that I drive in all the businesses we invest in, and make sure that any decision that they make, any strategic decision, includes their core competencies that they've built. What is a core competence? It's something where you have made a decision that on this particular aspect of the business I want to compete. So I will invest in it. I will deepen my USP in that particular space, and I will never outsource that. It'll always be in-house. It's core to the business. And the combination of 3 or 4 core competencies creates the USP, creates the unique selling proposition. And so when you're scaling, to me, if you're not using your USP, and I think we're saying the same thing,
Yes.
if you're not using your USP, then that's a bad scaling strategy. If you continue to use your unique, not USP, your core competencies, if you continue to use your core competencies when you scale, then you've got a lower learning curve now because you've been through a lot of that learning curve. Your USPs are inherent in that, and there's a sense of confidence as you roll out.
The last point I just want to, I think that you really put the nail on the correct attitude about margin and volume. It's a big mistake. It's always a big mistake. Volumes get assessed and are never there, and the margin doesn't support the lack of volume. Very important. I appreciate that, Matt, that comment. It's so valuable.
Thanks, Ellis.
Thank you. Thank you, Allon.
Great. Thanks, Ellis. While we're waiting for another question, Allon, we're just assuming that a business is going to a venture capitalist, but the other way of funding a business is via debt. When should a business go for debt, and when should it look for equity, either through a venture capitalist or friends, family, and fools?
Okay, so the answer is that equity is always the most expensive route. Okay, but it depends on what that equity comes with. So I always say to people, if you're just looking for money, please don't come to me, because I'm not the right person for that. If it's about gray hair and about experience, if it's about opening markets, if it's about bringing professionalism to your business, if it's about providing additional resources, if there is a leverage that comes with that money, not just the money, then equity, in my opinion, is the right route. If there is no leverage in that, if it's money equals money, then debt is by far the better opportunity. In fact, right before this here, I'm busy doing a deal, and the guy, I had the same conversation. He's now just got from one of the banks a substantial OD facility. And I'm phoning him up to say, do not do the deal with me. I'm actually phoning him to say, that's much better for you, because in my whole interaction with him up front, he's not writing down, he's not learning. So I can see that even though he presented that this was not just about the money, it's just been about what's the money, what's the rate, what can I, and the fact that there was a concurrent, going to go and get debt finance meant that was true. So I'm phoning up to say, no hard feelings. Really, that is the better route for you to go. And for me, by the way.
To end off, if we've got no more questions, any funny stories or anecdotes around being a venture capitalist? What's the craziest thing that you can think of off the top of your head in terms of the business itself or your experience or anything like that?
I think a great story that happened to me recently is a business I got involved in, and this always talks about valuation, that I got involved in a couple of years ago, had an offer to buy, not them out, but buy a piece of that business. And it was the piece of the business we liked the least. And the strategy was that we were going, let's call it strategy B, and the old strategy produced output A. And a competitor in the market who had just raised a huge amount of money only wanted A. And we said, do you want the whole business or do you want A? They said, we don't want the whole business. We don't even want your name. We don't want your CEO. We just want A. This is fantastic. Great. Kept the name, kept more important, my partner, which is way more important to me, the third part of the business was the technology, was part B. And so I've basically in a situation where I'm starting again with the same guys. But what's exciting is they are now investing themselves, because we sold for a substantial amount of money. So they're coming in now not as investees, but as partners, because they're putting their money in part two of the business together, and we're building part two of the business, or the second round of this business together, is not as investor-investee, but as two equal partners for putting money in. So that's a nice, that's one of my favorite stories, because, for a whole bunch of reasons. Yeah.
Fantastic. Excellent. I'm going to hand it over to Tracy. Tracy, over to you.
Thank you so much, Dave and Allon. Truly, what an amazing, amazing webinar. Anyone that didn't have an idea of how to pitch certainly has the 12 tools that you've shared with us this evening. And I thank you so much for your time this evening. It's always such a pleasure to host you on the OrtJet Zoom platform. It's completely inspiring. We thank you all for your time this evening. Allon, David, we look forward to seeing you both soon and working with you again. Thank you so much.